I'm joined by Kingsley Williams, who's the Chief Investment Officer at Satrix. And Kingsley's written an article recently talking about the arithmetic and the thoughts behind active versus passive. And I was fascinated by why you chose that topic. So, Kingsley, welcome to the channel.
Thanks for having me, Chris. Let me give you a quick summary of what the article was about, Chris. It was titled, "The Arithmetic is Not in Active Funds' Favour." And there are numerous studies that have been done around how actively managed funds perform relative to their so-called passive peers. S&P have got a survey called favour, which compares those numbers in the US, but also across different markets around the world, including South Africa. And then Morningstar actually does it on a global basis. But they published some research last year to the midway through 2023, and the title of the article indicated that a greater proportion of active funds were now outperforming their so-called passive peers over the last year. And so this may have created the impression that perhaps this would have been the end of the rise of indexation and the greater adoption of passive strategies in investors' portfolios. But what's quite interesting is that even though there was this increase, it was still only a third of actively managed funds that had managed to outperform their index tracking peers. And what's also interesting is as you expand that window longer than a year, say over a decade, which, to be honest, that's the minimum time that investors should be looking to invest in growth markets and risky markets like equities, then you see that the odds of an active fund outperforming its index equivalent drops down further to 17% in the equity space and only 23% of income or bond managers outperforming the indexation equivalent. So the point of the article is that the odds are very much stacked against most investors because there's a lot of selection risk. Just to give an indication, there are thousands of funds, 26,000 funds that were actually considered in the study globally. And you can think about the amount of selection risk that's inherent in identifying a manager or a fund that is likely to give you outperformance relative to the index equivalent. The cost and effort that goes into identifying that fund is obviously quite intensive. And then the other very important point is that over a given period, say 3 years or whatever, a top performing fund is inevitably not the same top performing fund over the next 3-year period. So there's not a lot of persistence in outperformance either. So that also makes the job even more difficult. In fact, past performance inevitably is a poor predictor of what future performance is likely to be.
Thanks, Kingsley. I also noticed the usage of two words. What's the difference between passive and indexation?
Yeah, I'm glad you asked that, Chris, because I think in many investors' minds, when you use the term passive, it's associated with a homogeneous thing, as in all passive is the same. It's all market cap weighted, high weighting to the large cap stocks, small weighting to the small cap stocks. Everything looks the same, but nothing could be further from the truth. While passive is probably most synonymous, what investors probably mean is a market cap weighted index in whichever universe they happen to be considering. Indexation is not limited to that only. In other words, you can design an index around any rules. The default or the most common way to benchmark a market is through a market cap weighted index, and that's your starting point. So your larger companies will have a higher weight, and your smaller companies a smaller weight. But there are numerous other strategies that can be encapsulated in an index, which form part of the broader indexation market. And the beauty of those types of strategies is that they also offer the potential for outperformance, which is the promise of what active management offers. So now you can actually have the best of both worlds. You can have a very cost-effective strategy, which is what indexation offers, but it doesn't have to be a market cap weighted strategy. It can be targeting value stocks, it can be targeting momentum stocks, it can be targeting quality stocks, or a combination of all three, or whatever other strategy that you might envisage that can be encapsulated in a rules-based framework. So we don't like referring to indexation as passive. I think passive generally has a negative connotation. And to add to that point, there is no such thing in my mind as passive investing. All investing requires active decisions. Even if the final decision is to follow a market cap weighted index, there are numerous active decisions that need to be made in reaching that final point. For example, what is your asset allocation going to look like? Which indices are you going to track within each asset class? All of those are very active decisions that need to be made along the investment journey, apart from the other very important issues like the appropriate vehicle to use, tax considerations, etc. The list goes on.
Thanks, Kingsley. Yeah, that clarifies the indexation versus and passive concept. But maybe just for those that are not 100% au fait with what active versus passive or indexation actually means, maybe just delve into the sort of logic, the difference between the two, and then some of the motivations behind that.
Yeah, sure, Chris. So I'm going to limit our conversation to a multi-asset framework, which I guess most of your audience, they would be looking at a balanced fund of sorts, or needing to manage a balanced fund of sorts within the regulatory framework. So if you think about it, that offers an investor or a manager the most degrees of freedom to add value relative to a benchmark, because you can add value in terms of the allocation to different asset classes, whether you're overweight that asset class or underweight that asset class at different times during an economic or market cycle. And to the extent that you can get that right tactically, you can add value. And then similarly, you can also add value within an asset class. So the stocks that you pick or the bonds that you hold within your bond allocation can add value as well. So that's often known as the selection effect. Can you pick the right securities within a particular asset class and also time your entry and exit with it, into and out of those securities? That can also add value. So within a multi-asset framework, there's the most degrees of freedom to differentiate and add value. And whereas with an indexed approach, particularly in the multi-asset context, what you'll typically find, there can be variations, but what you'll typically find is that at an asset class level, you are tracking a particular index. So you're not trying to outperform a reference benchmark for that particular asset class. And then similarly, you may or you may not be deviating tactically at an asset class level. So you either might be keeping your portfolio aligned with the strategic asset allocation through time, or you may have the option and the ability to deviate. It just depends on how the fund has been set up and what it's offering investors. But what we've found with some research that we've done is that particularly leading up to COVID and post-COVID, we went through a market period where there was heightened dispersion across asset classes. So what that means is that investors and managers had a lot of opportunity to add value within their balanced portfolios, because one asset class was behaving very differently from another asset class and outperforming or underperforming. There was big differences in returns between the different asset classes. So to the extent that a manager is able to make those calls correctly, they could have added significant value relative to a benchmark or relative to peers. So that's been the environment that we've been operating in over the last few years since COVID. But what we've seen is actually the very opposite in terms of fund performance from two dimensions. One, amongst active funds or across the category, there has been declining dispersion amongst funds, or declining variance of returns amongst different actively managed funds. So in other words, funds are clustering together and looking very similar, or not really departing from some reference benchmark or relative to peers. They're all sort of looking very similar and not taking advantage of this heightened dispersion that the market has offered. So that's the first thing we're observing. The second thing we're observing is that relative to rules-based or indexed balanced funds, which is what Satrix would offer, we're actually seeing a very low success rate of actively managed funds outperforming their rules-based or index-based equivalents. And so this is really puzzling to us because the market is offering rich opportunities for active managers to add value, which is the very promise of the higher fees that active management typically charges, and that's the promise of what active management offers, to be able to capitalize on these opportunities. Yet we're not seeing that in the performance coming through from these funds. In fact, quite the opposite. We're seeing rules-based index balanced funds sticking to a well thought through strategic asset allocation, actually having a significant advantage over their actively managed peers.
Kingsley, am I hearing you say that there's no place really for active management, or clarify that for me?
Sure. So to the contrary, and to my earlier point, I actually said there is no such thing as passive investment. And so actually all investing is active investing in one form or another. But to your question, there is absolutely a role for traditional active investment management or active portfolio management. The role that active managers fulfill is a very important one because they very much are unlocking and fulfilling a price discovery role within the market. So at Satrix, we definitely don't advocate for indexation at the expense of active management, or indexation only and no active management. We believe both have a very important role to play. But I think what investors should appreciate is that markets are becoming increasingly interconnected. Information is becoming a lot more real time, and the systems, and now with machine learning and artificial intelligence algorithms, investment managers are able to, and not just investment managers, investment banks and trading desks, etc., are able to act on information a lot quicker now than they were able to in the past. So I think it's fair to say that markets are becoming a lot more efficient, and it's becoming a lot more difficult to add value in the way that perhaps it was done a few decades ago. And so, I think as indexation continues to grow in our local market, and as we're seeing it grow in the US and in other markets around the world, it's going to increasingly highlight who are the managers that can add value long term, and what are the managers that are struggling to add value. And those managers that are struggling to add value are ultimately going to not be able to attract sufficient flows. Those funds are likely to close or be whittled out of the investable universe, and investors are going to be left with that equilibrium of a low cost option to get cost effective market exposure in a rules based or predefined way, and then they can obviously complement that with active managers that are also able to fulfill that price discovery role and add value through their process. So it's really not about one or the other. It's definitely not about a debate between active versus passive. It's really a combination of the two to get the best of what active is able to offer, combined with the best of what indexation is able to offer.
100%. Yeah, thank you very much. Interesting perspective. And it'll be worth watching this as it unfolds going forward, because things are progressing, as you quite rightly said. So we will certainly have a follow-up chat to this in the near future as well. Kingsley, thank you very much for your time. I really appreciate it, and love having you on the show, and we'll certainly continue the conversation.
Thanks for having me, Chris.